Returning to my Coin Lady channel, I am pleased to see you again. You are absolutely naive if you believe markets are extremely positive at the moment. And I'm going to present you with indisputable proof today that shows a recession nearly always follows a rate drop by the Federal. In today's video, I'll go over all the evidence that suggests the opposite is highly probable, based on a variety of historical events, so please don't pay attention to most of the noise you've been hearing recently. I'm going to show you guys pretty much irrefutable proof. Therefore, it makes no difference if you own Bitcoin, XRP, or Ethereum. What I am about to show you today is something you should definitely watch. I implore you to hammer the like button. We can now begin the video now that everyone has seen this. Firstly, I'd want to demonstrate the inverted yield curve percentage, which is decreasing from 92% to 67%, the most precipitous drop before 2020. Alright. The 2020 crash is the obvious next step. This is probably already well known to many of you. One of the worst market crashes we've ever seen occurred in 2007 and just around the time of COVID-19. In the midst of the economic downturn. Both the year 2000 and the dot-com bubble saw this happen. The current situation is similar to the last three big housing bubbles, COVID-19 recessions, and tech bust, all of which shared the same yield curve. Please take a look at this picture I've included. As far as we can tell, these are the calculation fields. The COVID-19 recession is shown at the bottom. The housing bust and the tech bust are here. You will observe each and every one of these, including the SNL crisis, the double-dip recession that occurred in the 1980s and 1978, and, of course, the inflationary collapse of 1973, which I bet you all are unaware of. It was still a double top, though. Now this is obviously very similar, isn't it? Here we had a massive peak, a price point in history that had never been witnessed before. Then there was the recent massive rate drop, which has caused this bubble to burst to some extent. And we should pay close attention to this because, if you're familiar with history, you'll remember the COVID-19 recession. What occurred then? It was completely out of this world. Just with the housing market crash of 2007 and 2008, this is something that those of you who were there will never forget. The market conditions were really terrible. What I'm trying to show you is that, yes, it's quite probable that we will encounter this again. I really hope you guys don't get caught in this kind of trap. I mean, we can't predict when it will happen, but when it does, I think a lot of people will be surprised because, well, nobody seems to be talking about what happens during these times. First, I'd want to show you a chart depicting the unrealized losses on investment securities for banks in the second quarter of 2024. If you're unfamiliar with yield curve inversions, you might want to pay attention. I mean, this is way worse than the financial housing catastrophe of 2007 and 2008, wasn't it? It appears quite insignificant in this way. Here we are. Discussing 512. Considered just the past 2 years, in the second quarter of 2024 alone, it reached $9 billion. The amount of damage that has occurred in such a short time is unbelievable. The Fed has been producing money at an unprecedented rate during this time, and it's no surprise. Unrealized losses accounted for 20% of the total for Bank of America's $110.08 billion held-to-maturity securities in Q2 of 2024, marking the 11th consecutive quarter of such losses as interest rates keep putting pressure on the economy. The bank is currently the second largest in the US. In the meantime, there were 66 institutions added to the FDIC trouble bank list in the first quarter of 2024, so don't kid yourself into thinking we're safe. Not to mention, the amount of unrealized losses here is unprecedented in history. Seriously, it's a complete zero. Look at the difference between 2006 and 2008, for example. That terrible economic downturn, yeah. Well, there you have it. Right now, that's the situation. You can't even begin to comprehend the magnitude of these figures, they're enormous. Many are wondering what must occur in order for us to also escape a recession in light of these unrealized losses. I have something that I think many of you will find shocking that I'm about to show you. Therefore, we must now discuss a soft landing as opposed to a recession. Historically, this has happened every time the Federal Reserve has cut interest rates by more than 200 basis points in a single calendar year. We can't turn a blind eye to the fact that the recession rate has been over 75% from September of this year, 2024, to September of next year, a period that is entirely within the Fed's plan. A very significant correction is likely if the probability of a recession is more than 75%. Plus, when you combine the unrealized losses from the past recessions, the dot-com bubble, the COVID boom, and the financial crisis of 2007 to 2008, with the unrealized losses from the preceding recessions, you get the whole picture. It seems to be, at the very least, a convincing argument. We must thus delve into it without delay. The market currently prices in a 50% probability of a US recession by June of 2025, and I want to be very clear, by this point, it's highly probable that we will have the 200 basis points I was mentioning. This proportion has increased by a factor of 2 in the past month. From July, it was just 10% higher. People did not anticipate this a few months ago, so it comes as a surprise. Also, there's a 50% chance, according to market estimates, that the Fed would lower rates by 200 basis points in the following 8 months. In contrast, the Fed is projecting a 150 basis point reduction in interest rates by the year's end, isn't it? About 150 or 200 basis points, then. Truthfully, it's difficult to say, isn't it? How extensive the Federal Reserve's actions will be. This is the expected outcome that the Federal Reserve has stated. What the Federal Reserve anticipates, however, is not always going to materialize, as history has shown. The market is certainly pricing in a recession right now, as you can see, and this follows a 50 basis point rate drop on Wednesday, which was the biggest surprise for markets since, of course, 2008. The viewer's presence here is greatly appreciated. Bye for now, and please subscribe and like my channel.